Welcome to the Plan Solutions Incorporated podcast, where we give facts and insight on the latest happenings in the world of economics, financial markets, and personal finance. Plan Solutions provides advice on a variety of financial topics, including investment management, tax preparation and planning, and retirement planning. Chase has 25 years of experience in the financial industry, holds a certified financial planner and chartered financial analyst designations, and has earned a master's degree in taxation and a doctorate in business administration. Chase has a passion for helping clients down the path toward their financial goals. And I'm Jason LaChance, and on this episode, we're going to discuss how to deal with market volatility, benefits of diversification, as well as inherited annuities, and a look at the Plan Solutions Incorporated Office Bulletin Board. Mr. Armour, how are we, good sir?
No, hanging in there. Into tax season. We've had some market volatility here. So, working hard, long hours.
Yes, sir. Well, very poignant to start with the first topic, how to deal with market volatility. As of this recording, we had just seen the announcement of President Trump concerning tariffs and some interesting occurrences going on. But we talk about market volatility frequently on here. So I have to ask, are we seeing one of these situations of maybe people over panicking a little bit much right now?
Possibly. I mean, that's hard to say. We really don't have a lot of data on what the impact will be. So right now it's a lot of speculation and people, in essence, pricing in their expectations, right? Expectations may be overblown, maybe underblown, right? So it's hard to say. And that's why I think, putting out this message of how to deal, psychologically with market volatility, I think is important because during these periods of stress and high volatility, we want to make good, rational, informed decisions, right? We want to stick to an investment strategy that has worked in the past, that's been back tested, that has a good theoretical basis. And you want to stick to it so that it helps you at least have a high probability of making good decisions. And I think the first thing that's often missed is, periods of market volatility, they're going to happen. And you could argue it's a feature, not a bug of the stock market, in that if the stock market, just produced consistent returns, if the returns are very consistent, we didn't see these periods of volatility, but instead it exhibited very low volatility. In essence, prices would be bid up to the point where they'd match that of lower risk investments. So, the rate of return expectation would fall to, what you would get in a money market or a low risk bond. And if that were the case, then that would eliminate the potential to achieve the higher rates of return that the stock market has historically presented. And if we didn't have that, that would make it very hard for a lot of people to be able to fund their long-term financial goals, like funding retirement. So, periods like this where we have to deal with the volatility and the stress, it can be challenging, but that's why we historically have been compensated with those higher rates of return.
Yeah, well, I know one of the things that you stress in the personal financial review here that really, helped me keep things in context and perspective is it's very useful to zoom out. Sometimes this means ignoring daily, weekly, or even monthly stock price charts in favor of long-term pricing. And that's an important thing. We've talked about the long game of it since we started doing this podcast.
Yeah, and this is a normal thing. It goes beyond just markets, right? They often talk about when, someone's faced with, danger or a crisis or something like that. What do they say? They get tunnel vision. Right? They zoom in, they get tunnel vision, they focus on just the thing in front of them, and maybe they miss other things that are going on that they should be paying attention to. So they don't have the broader context. It's just the way that we behave as humans, and it's the same in the stock market. We have a tendency that when the market's volatile, we just zoom into what it's done that day or that week or even that month, right? Ignoring that the goals that we're trying to fund could be years or decades. And so, one month in a year or decade span is really not meaningful in the big picture. One of the ways that can be done is we log on online, and what do they show you? They show you the daily price chart, right? And either that or maybe even a weekly or a monthly. But if you go in and you click on the longer term price charts, you start to see a different picture, right? I mean, when we put these numbers together, if you looked at a one price chart of the S&P 500, it would show that it was down 5.86%,
Mhm.
probably down a bit more today. But if you went and clicked on a 1 year price chart for the same S&P 500 index, you would see almost a 7% gain for the year. And a 5 year chart would show a 117% gain. Although to be fair, that would be back to 2020 when we were at the lows from the pandemic. So that's maybe not necessarily indicative of the long term of what you would expect, but it actually kind of demonstrates the point, right? If you sold during the pandemic, you missed out on that 117% rate of return over the next 5 years. Because if you zoomed in and only focused on what was right in front of you and happening in the short term and not that longer term, you could have ended up much worse off.
Yeah. Well, and another point that you bring up is that it could be beneficial to ignore stock prices during periods of volatility and instead focus on fundamentals. What do you mean by fundamentals?
Well, just everything related to the actual business, right? I mean, what are we seeing in terms of sales, earnings growth, cash flow, right? New innovations, new investments. I mean, all of those things that are the real reason why you would buy a business, not just because the price of the business moved a little bit,
Hmm.
right? I mean, if you think about it, no business owner would sell their business interests at a discount if they were seeing their sales and earnings that the business are generated, it continued to trend upward, continued to look solid. But for whatever reason, the price of their business is suddenly lower on that day or that week. They're not going to look at it and say, "Oh, well, then I need to rush out and sell my business." They're going to say, "No, I'm going to continue to, hold and work the business and, know that over the long term, those fundamentals really are what determines the value. And if those fundamentals continue to improve, that, the shorter term fluctuations that you see in prices will probably kind of average out."
Yeah. And another great point here, and we do talk about this frequently as well. When the stock market is down, even temporarily, the financial press is likely to turn negative. And boy, I just it seemed every story I was seeing on social media was all about this. That I was just like, yeah, I'm getting off this all the rest of the night because it seemed not necessarily misleading, but that was all it was about. It didn't have a broader scope to it.
Yeah, and it goes the other way. When the market's doing really well, then it becomes overly positive, right?
Mm.
It's just how the financial press works. I remember hearing an interview from someone who's retiring that had been in the financial press for years, and their saying was they learned very early on it's not the data or the news that explains the market. It's the market that explains the data or the news.
Hmm.
So if the market's up, everything's positive. If the market's down, it's all negative because, people go and they look and say, "Oh, look what the market's doing. I wonder why." And what they're looking for is an explanation. And sometimes there's not explanations that are readily available, or, maybe there's an idea of why the market's doing what it is, but how much real data or facts are behind that, right? But so what happens is it's just part of the news cycle and how you get clicks, how you get ratings is when the market's down, the news is going to be negative. It's not going to be objective. And vice versa. You need to remember that too when the market's really surging, right? It can create this sense of euphoria or, fear of missing out because everyone wants to jump in because everything's so positive and they say everything I'm hearing is so positive. But you have to realize you're kind of in an echo chamber at that point. It's just part of the process. It's not taking all of the facts and circumstances into account.
Yeah. And we do talk about this as well often, and it's so important to keep in mind is that time horizon. If your investments to fund retirement, as you said, it could be 10 years, 5 years, 3 years, 20 years, 25, 30 years.
Yeah, yeah. And you need to be realizing you have this really long time period, right? So chances are you're not going to need to sell any of these investments for quite a while. And so therefore they have a lot of time to recover. And then even then, once you retire, you're not going to sell everything, right? You're going to be selling a small portion, and you'll likely, have enough lower risk investments that you'll be able to tap those to fund those early years of retirement. So you have even longer until you need to, potentially pull money from those riskier investments that may be more volatile. So time horizon really matters, and so does the required rate of return, right? A lot of times people say, "Well, can I just sell everything and put it into a money market?" And I say, "Absolutely, you can. When are you going back to work?" And they say, "Well, what do you mean?" I said, "A money market will get you 4%. We're assuming 6. So if you put everything into something that's getting a 4% return, and we've built your retirement plan around a 6% rate of return." All you're doing is guaranteeing your failure. So you need to go back to work to make up that difference, right? You need 50% more money now, because you need more money so a lower rate of return on more money will still achieve the dollar rates of return that you need. I think that kind of helps to highlight that there are risks on the other side. There's risks to, making poor investment decisions or poor timing of when you make changes that then throw you off of your plan, and now you have a bigger risk of running out of money in retirement, which I would argue is the bigger risk, the risk of running out of money in retirement or falling short of the money needed to achieve a financial goal, as opposed to the risk that you see a dip in your portfolio value this month.
Speaking of portfolios, not looking at your portfolio values too often. Why is that? Is it where people maybe, I know with portfolios when we talked about it, and we're going to talk about diversification next, that maybe oftentimes people's knee-jerk reaction is to see parts of their portfolio that maybe is underperforming compared to others and panic and sell this off and like you said, put it in a money market, or that just leads to more panic sometimes.
Yeah, I mean, when you have short-term swings, if you're constantly watching it, right, you're just getting too deep into whatever's going on at that moment. Whereas if you look at it, like for example, if you look at it daily, you're going to see a lot of volatility, and pretty much half the time it's going to be up and half the time it's going to be down, right? So you're not really seeing the broader trend. If you look at it monthly, you're going to see, more often it's going to be up than it is down. If you look at it quarterly, then even more often you're going to see, positive returns. If you look at it annually, even more often. And that's really the longer term trend that we're trying to capture. So what you're doing is you're reinforcing the long-term reality that's actually occurred. Whereas if you get stuck on watching it, too often and getting sucked into it, you're not really seeing that bigger picture that is the reason that most people invest.
All right. Well, let's jump on over to benefits of a diversification. I think a perfect segue. Over the past couple of years, it seemed that less diversified investment portfolios, well, we're getting better results. So, what are we really seeing now, and what do we want to say about it?
Yeah, what's interesting, the first quarter of 2025, it seems like diversification's back in vogue. For a while there, returns were really dependent on how concentrated an investor was in a few leading stocks, mostly stocks tied to artificial intelligence, right?
Hmm.
And even got to the point where 9 of the top 10 holdings in the S&P 500 were all these companies tied to artificial intelligence because their value had grown so much. And they got to the point where they represented about a third of the S&P 500 index. So we're seeing this greater and greater concentration. But then you look at it and say, okay, well, if being highly concentrated has worked, I mean, isn't the point to be diversified, right? That's one of the things that you always hear. And so far, first quarter of 2025, we've really seen that. For example, the S&P 500 finished the quarter down 4.55%. But a much bigger portion of that was these growth stocks, right? And a lot of these AI kind of adjacent growth stocks. Whereas if you look at value stocks, the value side of the market, it was down just 0.16%. So basically even for the quarter. So being diversified and not being too overweight to growth, really reduced the drawdown that people were likely to see.
And what are we seeing concerning foreign stocks versus domestic?
Yeah, so that's another interesting one. I've had people, tell me the last, few months or so, why do we even own any foreign stocks, right? They haven't performed as well. Why would we want to have them? And then you get a year like we've had so far, and the main foreign stock index is actually up 7.64% for the quarter during a period where the S&P 500 is down 4.55%. So obviously seeing a huge benefit to diversifying and owning some foreign stocks to have a less concentrated portfolio and different risk factors that are going to behave differently. You look at that and you see a well-diversified portfolio that's not just focused on U.S. large growth stocks, but maybe owns a lesser portion of those, and also a fair amount of value stocks and some foreign stocks. I mean, a portfolio like that is probably pretty close to even for the year, whereas the broad market is down. So, those lower lows, smaller drawdowns during periods of market volatility is definitely one of the things that makes diversification valuable.
Yeah, is this just another example, like you said, of the value that makes diversification valuable of understanding the long-term goals as the investor and really, getting the overall picture of things and how it can go. There's going to be times where maybe it appears less diversification, or it not appears, but actually is maybe the course, but for a limited amount of time. These swings always come and go, and there's an ebb and flow, and it's that continuing to keep the long-term goal in mind.
Exactly. It's that reversion to the mean, right? During the good times, diversification should lead to reduced volatility. So during the good times, you may have reduced upside volatility, meaning, you won't see quite as high of highs, but you also during the bad times won't see as low of lows. And that will average out. You'll see that reversion to the mean, and we'll get quite often similar results, but with less volatility, which makes it a much more comfortable ride for most people.
Yeah. Anything you want to add before we jump to inherited annuities?
Well, I think, this comes back to a lot of the things we've talked about in the past, the benefits of rebalancing, the benefits of diversification, why you hold different asset classes and don't just load up on, whatever's hot and whatever's in the top thing in the media. And then, when you do see areas like growth stocks sell off, there may be a point to rebalance and move back into them when those prices are low, as opposed to, jumping on the bandwagon and buying them when their prices are high. And then, you're subject to potentially a larger drawdown like we're seeing now when sentiment shifts.
Let's jump on over to inherited annuities. Variable annuities may provide the benefits of tax-deferred growth and guaranteed income or death benefits, but they often come with additional costs and with less flexibility for future distributions. What are those the less flexibility and, as far as income tax rate, gains, limitations for beneficiaries and such?
Yeah, I think often one of the things that's not communicated effectively when it comes to annuities is, the impact it can have when it's passed to the next generation. With most non-retirement assets, if someone passes away, it gets a step up in basis, and so the heirs inherit it with really, little or no tax consequences, right? It can be that can be very attractive. Whereas annuities pass on any taxable gain onto the next generation, and a lot of people don't realize that that loss of a step up can reduce the end value by quite a bit when you have to take into account the tax burden. There's also a lot of annuities where if an heir inherits it, they have to distribute it within a certain time period, and so now not only do they have a tax problem, but that tax problem gets really crammed into a relatively few tax years, causing them to go into much higher tax rates. So we just point this out because we see it a lot, and a lot of times when we have those conversations, people say, "Oh, well, I did not realize that's how this works. This does not reflect my goals." So you want to make sure people are aware of that, having those conversations, and maybe looking at other alternatives. Unfortunately, annuities are sold quite often because they are the investment vehicle that pays the highest commissions. And so there's an incentive for the salesperson to, highlight the benefits and maybe not discuss some of these drawbacks or how it may not be the right vehicle if you're looking at not just a person's lifetime, but also their estate planning goals in terms of being able to leave money to the next generation and with flexibility and in a tax efficient manner.
Yeah. Could you expand on this a little bit? I found this really interesting where it states most annuities generally have 5 years to distribute 100% of the annuity or must annuitize, essentially turning over the money to the insurance company in exchange for a stream of lifetime income. Can you give a clarification on that? What it says in insurance company? So the annuity is something that would be purchased or set up through an insurance company, and then there's some sort of distribution where it can stretch out instead of that 5-year distribution?
Right. Yeah. So if there's a value in this investment annuity, right, and then you could either pull the money out within that 5-year time period. In this example, there may be some other options depending on the contract, or you can annuitize a contract. And what that means is you basically take all of that money and you irrevocably give it to the insurance company. So you cannot get it back. And then in exchange for that money, they promise you, let's say monthly payments for the rest of your life, or, monthly payments for the rest of your life plus a period certain, saying that we'll pay you at least 10 years or as long as you live, those types of things. But once you do that, you'll get that stream of income, but you now no longer have the flexibility of being able to access the principal in any way. And again, a lot of times that doesn't necessarily fit, someone's long-term goals, especially if it's a beneficiary and they're still working. Why would they want to start generating taxable monthly income that's going to be taxed at a high tax rate when maybe they want to be able to use this money more for their retirement? So yeah, the few options available can make planning rather challenging.
Okay, thank you for the clarification. Anything you want to add before we jump to the bulletin board?
Just that annuities are really, really complex, and I think it's worth doing your homework, talking to multiple people, getting a different second opinion before signing on. Because once you do, there can be really high costs to get out, and you can find yourself locked into certain features that again maybe are not the right fit for your long-term plans.
Yeah. All right, let's jump on over to the Plan Solutions Incorporated office bulletin board. One item pinned up there this week. What do we got for him, Chase?
All right. Well, we got April 15th coming up. So that's the tax deadline this year. Now, the question that comes up every year is people say, well, can I just go on an extension? And you can, right? You can get an automatic 6-month extension, which makes the new deadline October 15th to file the taxes. But what a lot of people don't realize is it's an extension of time to file your tax returns, right? Really, it's intended if you just don't have all of your information available, then you have that extra amount of time to file. But it is not an extension of time to pay any taxes due. So generally what you want to do is, calculate to the best of your ability what your tax liability will be, and then make a payment with the extension if it's needed. Because if you don't, and you end up, going on extension, you go past the April 15th deadline, you could end up being subject to interest and penalties on the amount due, even though you had an extension of time to file, because really you're paying, you're paying later than the deadline.
Anything else you want to add before we wrap up this edition of the Plan Solutions Incorporated podcast?
Just that I know we talked about market volatility. Obviously, We're here at the end of tax season. There's a lot of questions there. And, just reminding clients if they have concerns to give us a call, send us an email, right? That's what we're here for.
Absolutely. And all that information on whom you can call and email is in the description of the podcast. And we thank you for listening either on Apple Podcasts, Spotify, where we appreciate a follow if it's your first time, a rating and a review. And please share the podcast if you're getting value out of it with someone else you know who will also get value out of it. And we do have a YouTube channel if you want to follow along to the Personal Financial Review and hear the discussion that we have here on the podcast. You can do so by going to youtube.com/@plansolutions. And to subscribe to the Personal Financial Review, send Katie an email. That's KATIE @plansolutions.com and get subscribed today.
The views and opinions expressed in this podcast should not be construed as an offer to buy or sell any securities. The information may not be current, and Plan Solutions has no obligation to provide an updates or changes. Plan Solutions does not make any representation or warranty as to the accuracy or completeness of the statements or any information contained in this podcast or any liability therefor, including in respect of direct, indirect, or consequential loss or damage, is expressly disclaimed. Plan Solutions is not providing any financial, economic, legal, accounting, or tax advice in this podcast. In addition, the receipt of this podcast by any listener is not to be taken as constituting the giving of investment advice by any Plan Solutions associate or individual to that listener, nor to constitute such person a client of Plan Solutions. Any reference to a specific company or security does not constitute a recommendation to buy, sell, hold, or directly invest in the company or its securities. Market indexes are unmanaged and cannot be invested in directly. All price references and market forecasts correspond to the date of this podcast.
Plan Solutions is a registered investment advisory firm.